Well, hi there, everyone. Welcome to Chart This with Dave Keller. It's Monday, June 16th. I'm your host, Dave Keller, coming to you from a beautifully sunny Southwest New Hampshire, up in the hills in New Hampshire at music camp this week, playing trumpet, singing, experimenting with electronic music, having a ton of fun collaborating with professional musicians, composers. It is a great creative opportunity here. I am thrilled I was able to line up a trip out here for this camp with a little sliver of time I think I can get after the close to share some market thoughts with you. So bit of a different format this week. I appreciate you hanging in with me as I share some market thoughts, maybe a little differently than normal, but hopefully still quite valuable. And apologies that the format probably doesn't look and sound as awesome as it does from Redmond, Washington. But hey, we'll take what we can get. We're going to talk about the market conditions here. The S&P finishing higher by about 1%. The NASDAQ really leading the way higher, though, as volatility declines. So going into the weekend, it was a very concerning setup with the S&P and the NASDAQ selling off into Friday's close, creating what I would argue a very straightforward bearish divergence between price and momentum, between price and breadth. Some other things as well. Over the weekend with my Market Misbehavior Premium members, we talked in detail through a lot of those divergences, how I'm planning to sort of navigate this period, what sort of key items I'm on the lookout for. I'll share with you some little bits of that here today for sure as we debrief on today's market activity. So the S&P closing back above 6,000. Friday we actually closed just below 59.80. Today we're closing just around 60.33. So that's up almost a full percent from Friday's close. We did finish slightly above Friday's high, by the way. The NASDAQ composite closed just above 19,700. That's up 1.5%. Mid caps, small caps, both up about 1% for the day. We can see that the VIX actually moved lower, almost 2 full VIX points down. So it was up around 21 going into the weekend after Friday's drop. Today, moving back below that 20 threshold. So we are teasing that level. We are threatening that level, that sort of differentiator between a low volatility and high volatility environment. For today, it's telling you conditions getting a little better. We'll see if that holds through the remainder of this week, of course, as we go into the June Fed meeting. Looking at interest rates, you can see bonds sold off today. The TLT, which is a bond ETF, was down about 1%. The 5, 10, and 30-year points on the Treasury yield curve all drifted higher. So the 10-year points right around 4.45. The long bond yield just below 5% at 4.95. And the 5-year point actually touched 4% midday, but ended up rallying into the close or rising into the close as bonds sold off. The dollar index, something to watch. I grabbed a chart of the dollar index, which is ticker UUP on stock charts. On other platforms, you'll find it as something like DXY or something like that. But it's a dollar index, sometimes a trade-weighted dollar index, just depends on the provider for that. Here we're looking at the UUP, which is a dollar ETF. It's $USD on stock charts, but UUP is a good kind of proxy for the dollar strength because it's a bullish dollar ETF, up slightly. Now, what I would tell you is while stocks are having a bearish divergence, the dollar is actually having potentially a bullish divergence. I'll show you that chart here in a short while. Looking at the commodity space, you can see gold down today. The GLD was down 1.4%. That's coming off of a pretty strong, move on Friday. Overall, still remaining pretty good, above an ascending 50-day moving average, but certainly not moving up today. Silver slightly higher, 0.2%. Copper prices up 1.4%. Natural gas, the big winner. And after crude oil had a remarkable gap higher on Friday. With the news out of the Middle East today, moving down 2%. That's using the USO. Bitcoin driving to the upside here during the equity trading session. So, as equities rose, Bitcoin, Ethereum rose as well. You can see the top 10 coins tracked on the stock charts platform, all in the green. Bitcoin up almost to 109,000 as we're recording the show, just around 5 p.m. Eastern on Monday, June 16th. All right. Actually, let me keep going a little bit here. Go to the breadth conditions. Pretty good breadth. And that's been one of the real challenges with this market, particularly last week. The markets were, drifting higher on much weaker breadth readings. And that's concerning, right? That's a divergence, which we're seeing in a number of breadth indicators. I think most noticeably with the cumulative advanced decline lines, which all have been sloping downwards May into June, while the price of the S&P, the value of the NASDAQ 100 have both been trending higher. Today, however, breadth actually a lot better. We can see this is all in the green. On the S&P 500, 73% of the S&P members were up. On the New York Composite Index, about a 2-to-1 ratio of stocks up versus down. So those are pretty bullish readings. That's pretty good. And so I would say more days like today certainly should imply more optimism for the markets going further. Another pretty encouraging sign for today's session is that all of the Magnificent Seven stocks were up, which we've actually not seen in a little while. Meta up almost 3% today. Nvidia and Amazon both up 1.9%. Worst performer was Microsoft, which has been in a consistent uptrend since the gap higher last month, I think on earnings about a month ago in mid-May. Apple, Netflix both up about 1% as well. All right, let's briefly check in on the heat map. We will look at some of the some charts. We'll call it a day here. It's going to be an abbreviated look, but glad to bring some thoughts with you. Again, what I love about the heat map style visualization is it allows us to look sort of top level to lower level. Let me switch this to the 1-day change. All right, here we go. So things that strike me just as I was briefly reviewing this before we got started. Number one, just the strength in technology, right? Look at all the green that you see in the upper left corner. AMD up 9% today, almost 9%. A lot of the other semiconductors, Micron, Lam Research, Applied Materials, KLAC, even Intel having very strong updates. On Semiconductor, which is a name we've highlighted previously. And these are names up pretty well. And, when I'm looking at this market, while I'm seeing signs of, upside exhaustion, in a number of different ways, in breadth conditions, momentum conditions with divergences around, volume looking less ideal, DeMark indicators giving sell signal. That's all happened in the last week or so. Technology still looks fantastic, right? And charts like On Semiconductor, while still below a downward sloping 200-day moving average, are certainly continuing a remarkable uptrend that started the second week in April. So I'd say as long as stocks like On continue to pound higher highs and higher lows, how bad is this market? And the answer is really not that bad. So technology, I would say, certainly an area of strength. Financials have been actually pretty underwhelming here last week. Decent update with certain names like Capital One, Franklin, ticker BEN, Goldman, JP Morgan, both up about 2%. That's pretty impressive. I would highlight within the consumer discretionary sector, cruise lines like NCLH and Carnival, CCL, up over 6%. Gambling names like MGM, up 8%. Hasbro, up almost 3%. So a lot of names having a lot of really decent upside. Most importantly, the biggest one, Amazon, having a nice bounce higher, 1.9%. Outside of those growth sectors, and if you remove financials from the picture, not nearly as impressive. Note the pullback in energy. Energy stocks did remarkably well going into the weekend. Certainly with the news on Thursday into Friday, we saw the energy sector gap higher with the XLE moving aggressively on the crude oil news with news out of the Middle East and the bounce in crude oil prices. Today, you see Exxon and Chevron were slightly higher. Those are the two biggest names, big integrated oil companies. But after that, a lot of red there. And so, energy taking a breather. Utilities, one of the more defensive sectors, taking a breather as well. All right, let's finish off taking a quick look at some of the charts here. You can see the S&P 500. I'm featuring the bearish divergence that I think was confirmed on Friday's session, where we finally had enough of a pullback to, I think, declare that we have now had a bearish momentum divergence with higher highs in price, with weaker move in momentum, higher prices, weaker RSI. That's a bearish momentum divergence, implies exhaustion in the uptrend. Usually, you would see a downside reversal. And usually, this is an early warning system. We now need to look for confirmation. We need to look for actual price deterioration. We need to look for prices breaking lines in the sand for the market to move in this expected direction. And if not, if we see a move to new highs, and if we see additional momentum pushing us above this secondary peak in the RSI from last week, then the divergence is negated and we're back to a pretty clear bullish trend. Any trend following mechanism I use, including my market trend model, still quite bullish on the S&P and the NASDAQ. It's the underneath the hood indicators like breadth, like momentum, like volume that all took a concerning rotation lower through the end of last week. Today is a nice bounce higher. We'll see if that persists and if it's enough to make those bearish red flags start to disappear on the charts. We'll keep you updated for sure. Volume is one of those many things I think starting to show some real divergences. This is the Chaikin money flow, and I've highlighted with red arrows just what's happened here recently in May and June, but also what's happened at some previous market tops that we saw in 2024, which was the market moving higher, but the trend in the Chaikin money flow actually sloping downwards. What that means is that the market is strengthening, but on weaker volume. And it's not day-to-day volume only, it's volume trends. Look at just the last month, right? May and June. And if you can see here, these red bars are down closes, right? The black bars are up closes. Look at all the heaviest volume days have been on down moves. And that's the reality of how this market has been over the last 4 weeks. So even though we've gone higher, we've had these big distribution days on higher than average volume. That is causing the Chaikin money flow to slope downwards. That kind of divergence, similar to other divergences we've highlighted on the show last week, suggests weakening pressure pushing prices higher and implies a more concerning volume picture. We'll certainly keep an eye on that one. The VIX on Friday moved above 20. That is our warning level. That is our sort of differentiation between a low volatility, nothing to worry about kind of market and a higher volatility, we may need to be concerned kind of environment. That was just on Friday. Today, with the rally in stocks, we saw the VIX move back above 20. I think this is a crucial chart, certainly going through this Fed meeting, most likely no change. I mean, that's highly unlikely we get any change in policy. Certainly, investors will be hanging on every syllable of every word in the prepared statement and also certainly in the press conference at 2:30 Eastern later this week. However, I would keep an eye on the VIX. And if the VIX remains below 20, market's telling you nothing much to be concerned about. Just like we highlighted that bearish divergence on the chart of the S&P. And by the way, I wrote an article on stock charts on Friday, maybe Thursday, actually, covering that particular divergence. So make sure you check that out. But here on the US dollar chart, we're seeing a bullish momentum divergence, possibly lower lows from April to June, higher lows in momentum. We're oversold at the April low. We are not oversold at this point with the RSI more around 40. This kind of implies an upside rotation coming for the dollar. We now need to see that confirmed with an actual upside retracement in the dollar. That rotation higher in the dollar could mean a couple different things, but I would look to see if stocks or bonds start to rally, if you do see an influx in the dollar value, because that could tell us a lot about whether non-U.S. investors maybe are starting to allocate to U.S. markets in some way. Bitcoin, once again, testing that 110 to 112,000 level. That's a level that really we set in mid-May. We then retested it about a week ago. As of today, bouncing higher yet again, pushing 109,000 as we record the show today. I would keep an eye on that chart. Overall, I would say this is still a very bullish price structure with these multiple tests of an ascending 50-day moving average. I do have a position in Bitcoin and some Bitcoin ETFs, and I would say overall that trend remains quite positive. Some final charts to share with you, and again, I appreciate you guys with the tuning in on the adjusted schedule this week. Please put your questions in as we go. I should have mentioned that at the beginning. We're not doing the show live this week just because of some technology issues. However, I would encourage you to drop your questions, and I'll be reviewing those questions. Try to incorporate them into the show the best I can this week, but we'll definitely put some good questions into the mailbag. We're planning an all mailbag episode on Friday. We'd love to answer one of your questions on that show. All right, looking at the relative performance of some of these sectors. These are the three growth sectors. From the top, we have the relative performance in technology, then communication services, then consumer discretionary. In the last 4 weeks, we'll start from the bottom and go up. Consumer discretionary, the XLY, has underperformed. That's in no small part because of the weakness in Tesla, to be sure. Not enough of a rally in those big names like Tesla and Amazon to change the trend in deteriorating relative strength. Communication services has been flat for the last 4 weeks. Indeed, it's been flat for the last 4 months, going back to mid-February. We're almost at exactly the same level on a relative basis. Technology is the outlier here. I would argue that this is not a growth advance at this point from mid-May to mid-June. It is a technology-driven advance. It's semiconductors, it's software names, It's a bunch of different things, but it is the technology sector. It is not growth over value, although that may be what the ratio is doing. It's really within the growth space. It's technology that's starting to differentiate itself. And I would say the trends in charts like Microsoft really allowing these uptrends to continue. It's certainly semiconductors like ON and others that are having these nice upside follow throughs. The SMH is a great way to follow that trend. But I would say with Microsoft in particular, after the gap higher on earnings at the end of April, May, and so far in June has just been lights out bullish with like 1 or 2 days as an exception. Overall, the trend has been remarkably strong. There's no divergences here. There's no sign of a change in trend. I think those are the charts to watch. Something like this, I think you go full trend following mode. I'm featuring the chandelier exit system, which is something that Dr. Alexander Elder popularized in one of his books. I think Come Into My Trading Room or The New Trading for a Living. I should know that. I always forget. But if you review his books, he talks about this. It's an average true range based trend following, sort of trailing stop system. Gives you a great way of just locking in these additional gains as long as the trend persists. Charts like that, that's the kind of indicator I like to focus on, because that's one that's going to tell you when the trend is probably exhausted. That'll do it for today, folks. Thanks so much for watching this week. Thanks so much for following my work and all through the year, but especially I appreciate you giving me some flexibility to come up and do something that I'm very passionate about. The school I'm at, by the way, is called the Walden School. If you want to check it out at waldenschool.org, it is a magical place where creative adults, creative school-age kids coming later this summer come and make music and grow together as musicians, as creators. It's a wonderful, wonderful, special place, and I'm thrilled to be here for the week. Also excited to grab some time here every day and share some market observations with you. Please keep your questions coming wherever you're watching the show in the comments section. We'll gather those questions and hope to answer one of your questions on our all mailback episode on Friday. In the meantime, have a fantastic week. Remember, don't fight the Fed and don't fight the tape. And also remember, it's always a good time to own good charts. Have a great night, folks.